Welcome to the International Accounting Channel. Remember to subscribe the channel, like, and share with everyone. Today we share a lesson about inventory. Hope it will be helpful to you. Now let's get started. Inventory is a quantity of the goods and materials that a business holds for the ultimate goal of resale, production or utilization. According to IAS 2, inventories are assets held for sale in the ordinary course of business, in the process of production or business for sale, raw materials, tools and supplies for use in the production, business or provision of services. Types of inventory. 1. Finished goods is inventory that has been completely built and is ready for immediate sale. Finished goods consists of the raw material cost, direct labor, and an allocation of overhead. 2. Work in progress consists of all partially completed units in production at a given point in time. 3. Raw materials is any material directly attributable to the production of finished goods but on which work has not yet begun. Determine original price of inventory. The original cost of inventories includes purchase costs, processing costs and other directly related costs incurred in bringing inventories to their present location and condition. 1. Purchase costs include purchase price, non-refundable taxes, transportation, loading and unloading, storage costs during the purchasing process and other costs directly related to the purchase of inventory, trade discounts and reductions in purchase prices due to incorrect specifications and quality are deducted from the purchase cost. 2. Processing costs include costs directly related to manufactured products, such as direct labor costs, fixed manufacturing overhead costs and variable manufacturing overhead costs incurred in the process of converting raw materials and supplies into finished products. 3. Other directly related costs. Other costs included in the original cost of inventories are costs incurred in bringing the inventories to their present location and condition. Recording of original cost of inventory. Inventory must be recorded at the lower of cost and net realizable value according to the principle of prudence. Costs not included in the original cost of inventory. Value of losses arising above the normal level of raw materials or other production costs, storage costs unless these costs are necessary for the next production stage, business management costs, selling costs. Method of calculating inventory price. 1. Specific practical method. This method is appropriate for inventory items that are segregated for specific projects, regardless of whether they are purchased or produced. However, the specific identification method is not appropriate for inventory items that are characterized by a large number of items in the same category that are interchangeable under normal conditions. In these situations, a method for selecting individual items in inventory can be used to determine the impact on the income statement in advance. 2. First in, first out, FIFO method. This method is based on the assumption that the goods purchased or produced first are sold first, and The remaining goods at the end of the period are the goods purchased or produced at the end of the period. According to this method, the value of goods issued is calculated based on the price of the goods imported at the beginning of the period or near the beginning of the period. The value of inventory is calculated based on the price of goods imported at the end of the period or near the end of the period that are still in inventory. 3. Weighted average. According to this method, the value of each type of inventory is determined based on the weighted average value of similar items in each type of inventory at the beginning of the period and purchased or produced during the period. The average value can be calculated by period or by each import, depending on the actual situation of the enterprise. Currently, IASO 2 does not allow the use of the last in, first out, LIFO method. Inventory is recognized as an expense when inventory is sold or allocated to other assets. 1. When inventories are sold, the carrying amount of inventories is recognized as an expense in the period in which the related revenue is recognized. When inventories are written down from cost to net realizable value, the difference between the cost of inventories and net realizable value is recognized as an expense in the period or as a loss. Reversal of inventories arising from increases in net realizable value. The corresponding amount previously written down is recognized as a reduction in expenses incurred in the period in which the reversal is made. 2. Some inventories may be allocated to other assets. For example, inventories used as part of self-constructed property, plant, machinery and equipment. These inventories will be recognized as an expense over the useful life of the asset. Determining the balance of inventory. The ending balance of inventory for a period depends on the volume of sales a company makes in each period. The basic formula for ending inventory is ending inventory equals beginning balance plus purchases subtract cost of goods sold. Higher sales, and thus higher cost of goods sold, leads to draining the inventory account. The conceptual explanation for this is that raw materials, work in progress, and finished goods, current assets, are turned into revenue. The cost of goods flows to the income statement via the cost of goods sold (COGS) account. Inventory on financial statements. 1. IASO 2 stipulates that in financial statements, enterprises must present the accounting policies applied in measuring the value of inventories, including the methods of calculating the value of inventories, the total carrying amount of inventories and the carrying amount of each type of inventory are consistent with the entity's classification. The carrying amount of inventories is recorded at fair value less selling costs. The value of inventories is recorded as an expense in the period. The amount of inventory write-downs is recorded as an expense in the period. The reversal, for previously written down inventory values, is recorded as a reduction in expenses in the period. The carrying amount of inventories is considered to be a guarantee for payables. Information on the remaining value of each type of inventory and the fluctuations of these assets during the period is useful information for users of financial statements. The classification of inventories usually includes goods, raw materials, tools and equipment used for production, unfinished products and finished products. The value of inventories recognized as expenses in the period is usually presented as cost of goods sold. This cost of goods sold includes the costs previously recognized in the value of inventories being held for sale plus unallocated manufacturing overheads and the value of the normal surpluses arising in the production process. 2. Format. Some entities use a format for reporting results of operations that presents results other than recognizing inventory as an expense during the period. With this format, the entity divides costs according to the nature of the cost. In this case, the entity presents the elements of the cost of inventories recognized as expenses, including raw materials and goods, labor and other costs, together with the net change in inventory during the period. 3. Inventory impact on financial statements, balance sheet, changes in inventories and incorrect inventory balances affect your balance sheet, the financial statement that is a snapshot of your company's worth based on its assets and liabilities. An incorrect inventory balance can result in an inaccurately reported value of assets and owner's equity on the balance sheet. However, it does not affect liabilities. Moreover, changes in inventory valuation methods can lead to variations in asset values reported on the balance sheet. This can affect key financial ratios, such as the current ratio and asset turnover, which investors and creditors often use to assess the financial health of the company. An inventory write-down due to obsolescence or shrinkage directly reduces the total value of assets. This diminishes the overall equity reflected on the balance sheet, possibly creating the impression of lower financial stability. Regular reconciliation of inventory helps ensure accurate financial reporting and avoids long-term discrepancies. Cash flows. If a business uses FIFO when prices are rising and inventories are also rising, COGS would be low and net income would be higher. As a result, the company would have to pay higher taxes. This would result in a lower cash flow for the firm. Additionally, businesses that mismanage inventory by overstocking or understocking can cause fluctuations in cash flow. Overstocking leads to unnecessary capital being tied up in inventory, which could otherwise be used for operational needs or investments. Understocking, on the other hand, could lead to lost sales and missed revenue. Opportunities, negatively impacting cash inflows. Cash flow forecasting depends heavily on accurate inventory management. Predictable inventory turnover ensures that a company can better anticipate cash needs for purchasing new inventory or paying off suppliers. Proper alignment between inventory purchases and expected sales can improve liquidity and ensure smoother day-to-day financial operations. Working capital. Working capital is defined as current assets minus current liabilities when inventory goes up in the income statement. The working capital would also go up. An efficient inventory management system ensures that working capital is optimized by balancing inventory levels. Excess inventory unnecessarily increases current assets but doesn't immediately contribute to revenue, while too little inventory can hurt revenue generation and operational efficiency, reducing overall profitability. Maintaining the right balance is essential for sustaining positive working capital. Inventory management impacts liquidity, a critical aspect of working capital. Proper turnover ensures that resources tied up in inventory can be converted to cash quickly to pay off short-term liabilities. This flexibility helps businesses maintain financial resilience and adapt to sudden changes in market conditions or unexpected expenses. The income, profits, if there are any errors in calculating inventory, there would be cascading effects on COGS, profits, and income. There are several reasons why your inventory might be inaccurate. Some instances include breakage during transit, not adding returned goods to inventory, and old goods which might have to be sold at a discount. In all such cases, you need to adjust your inventory to an accurate value. Adjusting inventory cannot be an annual affair. This should be done more often so that there are no major changes to the inventory value during the time of change. For this, companies often use an inventory reserve account, where obsolete or unusable inventory is recorded as a percentage of the inventory value. The inventory reserve account is a balance sheet account and would have a negative balance. If you pit it against the inventory account, you would get an accurate idea of your inventory. Thank you for watching our channel. See you again in the next video.